3 months ago, silver hit $121 an ounce, an all-time record, the biggest rally in 46 years. People were calling it the trade of the decade. Today, as I'm recording this, silver is sitting at $77. That's a 40% crash in under 90 days. And most people watching their portfolios right now are looking at that chart and thinking the silver story is over. They're wrong. And I'm going to show you why the smart money, the big institutional buyers, the central banks, the Chinese industrial giants are not selling this crash. They are quietly buying every single ounce they can get their hands on and paying premiums that haven't existed in modern market history to do it. Because here's what nobody on CNBC is telling you. Physical silver in Shanghai has been trading up to $15 an ounce, higher than the paper silver price in New York, for months. On some days, it was a 12 to 13% premium. That is not a normal market. That is a broken market. And when physical commodity markets break away from paper markets, history is extremely clear about what happens next. COMEX registered silver inventories, the physical metal actually available for delivery in New York, are down nearly 70% since 2020. The London vaults have lost around 40% of their holdings. In one 7-day stretch in January, 33 million ounces of silver were physically withdrawn from COMEX. 26% of the entire registered inventory, gone in a single week. Bank of America is now calling for silver to potentially hit $300 an ounce. Citigroup has a $150 to $170 target. Reuters polled institutional analysts, and the consensus 2026 average just got revised from $50 to nearly $80. JP Morgan sees it rising further into 2027, and I'll show you why they might all still be underestimating this. Stick around, because in the next 25 minutes, I'm going to break down exactly what's happening in the silver market. Why the 40% crash is actually the setup, not the end of the story. The 3 buyers draining Western vaults in real time. The 3 times in recent history we saw this exact same paper versus physical disconnect. And what happened to prices every single time. And what you need to understand before the next move hits. Let's get into it. First, let me explain what a Shanghai premium is and why it matters. Because this is the single most important signal in the silver market right now, and almost nobody in mainstream finance is talking about it. In a normal functioning global market, the price of silver in London should equal the price of silver in New York, should equal the price of silver in Shanghai. Give or take a few cents for shipping, insurance, and local demand. That's how global commodities work. Oil in Houston costs roughly the same as oil in Rotterdam. Wheat in Chicago costs roughly the same as wheat in Singapore. The price gaps are tiny because traders close them instantly. See a price mismatch, buy cheap, sell expensive, pocket the difference. The gap closes. Textbook economics. For silver, normal premium between Shanghai and London is about 50 cents to $1 an ounce. That's shipping and insurance costs. Normal. Now here's what actually happened. In late December 2025, the Shanghai premium blew past $8 an ounce. By early January 2026, it was widening even further. For most of this year, physical silver on the Shanghai Gold Exchange has been trading at premiums of 10 to 15% over the Western paper price. At one point, physical silver in Shanghai traded above $80, while COMEX futures were pricing silver much lower. That's not a 50-cent gap. That's an entire paycheck per ounce. When you see a price gap that big, that persistent, across the 2 biggest commodity markets on Earth, there's only one possible explanation. Traders aren't closing the gap, which means traders can't close the gap, which means the physical silver needed to ship from London to Shanghai and cash in on the arbitrage simply doesn't exist. There's not enough real metal in the system to make the math work. And that is the entire story. The paper price of silver, the one you see on CNBC, the one futures traders quote, the one your silver ETF tracks, that price is based on contracts, IOUs, promises to deliver silver someday. The physical price, the one buyers in Shanghai are paying right now in cash for metal they take home today, is the real price. And those 2 prices have been saying completely different things for months. Now, here's what's wild. The Shanghai Gold Exchange in China is structurally different from COMEX in New York. On the SGE, most contracts actually settle with physical delivery of real silver bars. On COMEX, 99% of contracts settle in cash. Nobody takes delivery, they just pass paper around. So when Shanghai prices say silver is worth 10% more than COMEX prices, say, Shanghai is telling you what real silver actually costs. COMEX is telling you what a promise of future silver costs when nobody's actually checking if the silver exists. The problem is, people are finally starting to check. Between the first week of January 2026 and the middle of that same month, 33.45 million ounces of silver were physically withdrawn from COMEX vaults in 7 days. Let me repeat that. In 1 week, 26% of COMEX's registered inventory disappeared. This has never happened before. Not in the 2008 financial crisis, not in the 2011 silver spike, not even during the Reddit silver squeeze in 2021. Why did it happen? Because the paper market system has a fatal flaw that finally got exposed. For decades, the amount of silver promised on paper, through futures, through ETFs, through unallocated accounts, far exceeded the amount of real silver actually sitting in vaults. At the peak, the paper to physical ratio in silver hit 356 to 1, meaning for every 1 ounce of real silver sitting in a vault, there were 356 ounces worth of promises floating around in the financial system. That system only works on one assumption. Nobody asks for all the silver at the same time. In January, that assumption broke. Institutional buyers woke up and realized physical silver was scarce, premiums were widening in Asia, and they would rather hold the metal than the paper. So they stood for delivery. They demanded the actual silver their contracts entitled them to. Comics had no choice. The silver had to be delivered. Vaults got drained. Silver shot from the 30s all the way up to that $121 peak on January 29th. And then the CME Group, the exchange that operates Comics, did what exchanges always do when a market starts breaking. They raised margin requirements. They made it more expensive to hold long silver positions. Leveraged traders got margin called, forced to sell. The dollar simultaneously strengthened because of the Iran conflict pushing oil higher, and silver crashed 40% in a matter of weeks. Now, here's what the media told you. Silver bubble popped. Speculation unwound, back to normal. Here's what actually happened. The financial plumbing got tightened to stop the squeeze from fully playing out. But none of the underlying conditions, none of them, have changed. COMEX registered inventory is still only around 76 million ounces, against open interest representing hundreds of millions of ounces, coverage ratio of just 13%, meaning if even a fraction of contract holders demand delivery, the exchange runs dry all over again. LBMA vaults in London are still drained to decade lows. Shanghai premiums are still elevated. China is still buying. The Silver Institute still projects a 6th consecutive annual supply deficit in 2026 of about 67 million ounces, meaning the world is burning through more silver every year than it mines. And the deficit keeps compounding. The squeeze wasn't solved, it got paused, and when it comes back, it's going to come back against an even tighter physical market than last time. Now let me show you who's actually buying. Because once you understand the buyers, you understand why this isn't stopping. China controls something like 2/3 of the world's silver refining capacity. They make the vast majority of the world's solar panels. They dominate EV production. They're the biggest manufacturer of electronics on Earth. All 3 of those industries are silver intensive. A single solar panel needs about 20 grams of silver. An EV uses roughly twice as much silver as a combustion car. And every AI data center and 5G tower being built needs silver for high conductivity connections. Chinese industrial buyers are doing something unusual right now. They're pre-purchasing silver 12 to 18 months in advance, taking physical delivery, storing it in warehouses. This is not normal behavior. Normal industrial users buy silver as they need it. When they start hoarding, it means they think future prices will be much higher, or future supply won't exist at all, probably both. For 3 consecutive years, central banks have bought over 1,000 tons of gold annually. That's record-breaking accumulation year after year. But most people don't realize that when central banks start stockpiling precious metals at that pace, silver buying often follows quietly in the background. China has been especially aggressive. In 2025, China formally reclassified silver as a strategic material. That changes everything. Strategic materials get export controls. Strategic materials get priority allocation to domestic industry. Strategic materials are hoarded, not traded freely. When the world's largest silver refiner declares silver a strategic asset, the silver that would normally flow into global markets stops flowing. Global supply tightens. Western vaults get drained to fill the gap. Prices go up. This one is the biggest shift. The iShares Silver Trust, SLV, has seen record inflows this year. Hedge funds are demanding physical delivery on their COMEX contracts instead of cash settlement. Family offices are quietly moving from ETFs into allocated vaulted silver. Why? Because they figured out that paper silver isn't the same thing as real silver. And when a squeeze hits, only real silver actually protects you. If you hold a silver ETF and the ETF has to sell physical silver to cover redemptions during a shortage, guess what? The share price of the ETF can absolutely collapse, even while physical silver prices go to the moon. Paper and physical stop tracking each other. That's the entire lesson of the last 6 months. Between industrial hoarding, central bank accumulation, and institutional rotation from paper to physical, demand is running well above what the world actually mines. And it's been doing that for 6 straight years. The Silver Institute is projecting the deficit for 2026 alone will be around 67 million ounces. That gap has to be filled from somewhere. Right now, it's being filled by draining every vault on Earth. Once those vaults hit empty, There's only one adjustment left: the price. Go ahead and like this video if the Shanghai Premium now makes sense. It helps more people see this. Now let me show you why this paper-physical disconnect always resolves in favor of physical. 3 case studies from recent years. April 20th, 2020, NYMEX crude oil futures crashed to negative $37 per barrel. First time in history. Traders were literally paying people to take oil off their hands. But here's the trick. Physical oil never went negative. Real tankers full of crude were still selling for $20 a barrel in the spot market. The disconnect existed because futures contracts that month required physical delivery, and nobody had storage space left to take it. The paper price lied. Physical price told the truth. Within 6 months, oil was back to $75. Anyone who panicked and sold based on the negative number got destroyed. Anyone who understood the disconnect made a fortune. March 8th, 2022. Nickel futures on the London Metal Exchange spiked from $29,000 per ton to over $100,000 in less than 24 hours. Trading got halted. The exchange canceled billions in trades. What caused it? A Chinese company had a huge short position, but there was a physical nickel shortage due to Russian supply disruptions. When they tried to close their short, they couldn't find physical nickel anywhere. They had to buy futures at any price. The paper price said nickel was worth $30,000. The physical market revealed the real price was 3 times higher when you actually needed delivery right now. Palladium futures were trading at $1,400, but automotive manufacturers couldn't secure physical palladium for catalytic converters. So physical palladium traded at $1,800 to $2,000 in the spot market. That gap lasted for months. Eventually, futures caught up. By February 2020, palladium hit $2,175. Physical forced paper to adjust, not the other way around. Here's the pattern, every single time. Paper market says one price. Physical market trades at a premium. The disconnect lasts until either physical supply increases, which almost never happens, because supply is by definition constrained, or paper prices explode upward to match physical reality. Silver is showing us this exact pattern right now. Shanghai, screaming $80 plus. COMEX pretending it's $77. One of those prices is lying. History tells us which one always is. Now, let me tell you why I think the January crash was actually the bullish setup, not the end of the run. In every major commodity bull market, you get these violent 30 to 50% corrections in the middle of the run. They shake out the weak hands, they scare off the speculators, they reset sentiment to bearish, so the next leg up has room to run. Silver corrected from $121 to $77. That's a 40% pullback. Brutal. And it wiped out a lot of the leveraged longs who piled in at the top. It also created a wall of skepticism. Open any finance publication right now and you'll find plenty of analysts calling for silver to drop to $54 or even lower. Bearish sentiment is back. Meanwhile, nothing structural changed. Supply deficit still there. Shanghai premium still elevated. Industrial demand still growing. Central banks still buying. China's export reclassification still in effect. The most bullish thing you can have in a structurally strong market is a brutal correction that makes everyone hate the asset, because that's the setup for the next leg. Here's what the big institutions are saying right now. Bank of America has a bull case scenario of $135 to $309. Citigroup target is $150 to $170. TD Securities is the most bearish at $44. LBMA analysts polled range from $42 on the low end to $164 on the high end. The consensus 2026 average got revised to around $80. And the most aggressive forecasters, like David Hunter and some LBMA respondents, are calling for over $180. Now, I'm not telling you silver is going to hit $300 by December. That's a wild take. What I am telling you is that the structural setup for silver is the tightest it's been in my lifetime. The physical market is telling you the paper price is wrong. And when physical markets break away from paper markets, history is exactly zero forever in resolving the other direction. Industrial demand from solar, EVs, AI, and data centers is growing structurally. Supply from mining is flat. The deficit keeps compounding. Central banks keep buying, China keeps hoarding, and Western vaults keep draining. The question is not whether silver reprices higher. The question is when and how violently. So what do you actually do with this information? First, and I have to say this, nothing in this video is financial advice. Silver is volatile. We just watched it drop 40% in 90 days. You can lose real money in this market. Do your own research. Talk to a qualified advisor who actually knows your situation. I'm an educator, not your financial planner. Now, with that out of the way, here's the framework I'd think through if I were building my own view. Question 1. Do you understand the difference between paper silver and physical silver? Because in a squeeze, they are not the same asset. A silver ETF is a promise. A silver coin in your safe is silver. When the music stops, those two things behave very differently. If you own silver for squeeze protection and you own it through a paper product, you may not be getting the protection you think you're paying for. Question 2. What time frame are you playing? If you're trying to trade the next week, silver could easily drop to the mid-60s before the next leg up. The CoinCodex algorithm is forecasting a slight decline in the next 7 days. Short-term traders need to be careful here. If you're playing the structural story over 12 to 36 months, the setup looks very different. Question 3. What percentage of your portfolio are you comfortable putting at risk? Silver moves 3x gold's percentage in either direction. That cuts both ways. 40% down, but also 140% up last year. Size your position so you can sleep at night. Question 4. Are you prepared for volatility? Because if this next leg plays out like past silver runs, we could see 10 to 20% daily moves, both directions. That is not a market for people who panic at a red candle. The people who make money in commodity squeezes are the ones who understand the structural setup, position before the obvious move, and stay disciplined through the chaos. The people who lose money are the ones chasing tops, panic selling bottoms, and trading on hype instead of data. The structural setup right now is genuinely historic, but how you position matters way more than being right on the call. Let me leave you with this. The Shanghai premium is not going away. It's going to either close, which requires silver prices to explode higher, or it's going to keep widening, which means the paper market completely loses credibility, and we end up with even higher prices anyway. There is no third path. Physical supply can't meaningfully increase. Mining output is what it is. Scrap recycling is already maxed out. Western vaults are getting drained to historic lows. Bank of America is calling for up to $309. Citigroup sees $170. JP Morgan sees steady gains into 2027. The Silver Institute is forecasting a 6th consecutive supply deficit. China is hoarding strategic reserves. Solar and EV demand is growing structurally, and all of this is happening while most retail investors think the silver story is over because of a single 40% correction. This is exactly how structural bull markets work. The big moves happen when everyone thinks the move is done. Now I want to hear from you. Are you buying this dip, or do you think silver has more downside before the next leg up? Drop your target price for silver by the end of 2026 in the comments. I read every single one of them, and the comment section on these videos is honestly the best part of making this channel. If this breakdown actually helped you understand what's happening in silver right now, do me a huge favor. Hit the subscribe button. Because the next 90 days in precious metals are going to be wild, and I'm going to be here breaking down every major move as it happens. Central bank announcements, CPI prints, COMEX inventory updates, FOMC decisions, Shanghai premium shifts. All of it in plain English, with real data, no hype. The video on screen right now is my full breakdown on gold hitting $4,800, which is a completely different story with its own massive setup. Watch that next, because gold and silver are moving for connected but distinct reasons, and if you understand both, you'll see the bigger picture nobody else on Finance YouTube is putting together. Stay safe, stay disciplined, stay skeptical of anyone promising you easy money. See you in the next one.